Imagine it's 17 October 2019. You are a 43-year-old construction worker living in Beirut, Lebanon. Your name is Nadim Sroor. After years in the Gulf, you have come home with your wife and 2 sons. Most of your savings are sitting in a Lebanese bank, waiting for the apartment you plan to buy. The Lebanese pound has been tied to the US dollar for more than 20 years. That fixed rate feels as solid as the concrete towers rising over the city. In the evenings, the streets are crowded, the shops are open, and the hardest part of your life seems behind you. Money looks steady. If you have ever wondered why ordinary people work for decades and save carefully, doing everything right and still waking up to find their money has changed into something else, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, in different countries, under different flags, and it always leaves a scar. If you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead. Then the floor shifts. Protests erupt across Lebanon after the government proposes a tax on WhatsApp calls. Foreign money stops flowing in. People crowd outside bank branches. Then the doors close. The dollars in your account are still there on paper, but paper is the important phrase. You cannot freely take them out. If you can get access at all, it is often in Lebanese pounds. This happens at a rate far below the real street price. By 2021, the World Bank describes the collapse. It is one of the top 10, possibly top 3, most severe crisis episodes in the world since the mid-19th century. The system did not run out of numbers. It ran out of belief. That is what this video is about. What actually happens when trust in money breaks? I mean the moment when people stop believing that the money they earn today will hold value tomorrow, or even be available when they ask for it. History shows that this can happen through hyperinflation. This is when prices rise so fast that money melts in your hand. It can happen through bank freezes. This is when your balance exists, but becomes unreachable. It can happen through a broken currency peg, which means a government promises one exchange rate until it can no longer defend it. Different costumes, same play. And once you see the mechanism, you start to understand the suddenness, even though these episodes build for years in plain sight. Before we go further, understand something important. Money is not valuable because it is made of paper, polymer, metal, or pixels. It is valuable because millions of people agree to treat it as a bridge between today and tomorrow. A banknote is a promise. A bank balance is a promise about a promise. And a promise works only while enough people believe it will be honored later. Think of trust in money like the invisible steel inside a skyscraper. You do not see it when the sun hits the glass. You only notice it when the building begins to lean. A currency can look normal on the outside, while the beams inside are already rusting. Governments can print more claims on wealth than the economy can support. Banks can promise instant access to money they have already lent long term. States can fix their exchange rate to a stronger currency and pretend their own finances are just as strong. For a while, this works. That is the dangerous part. It works just long enough to teach the wrong lesson. When trust begins to crack, people do not react in an abstract way. They act physically. They run to banks. They empty shelves. They demand wages faster. They switch into dollars and gold. They buy food, fuel, land, inventory, or anything else they believe another human being will still want. Economists call this a flight from money. In plain English, people stop holding the thing. It means the thing that is supposed to hold everything else together. And once that starts, it feeds itself. The more people flee, the weaker trust becomes. The weaker trust becomes, the faster people flee. Collapse is not always a bomb. Sometimes it is a line outside an ATM. Sometimes it is a salary paid in the morning that cannot buy dinner by nightfall. Keep that mechanism in your mind because it is the secret key to every story that follows. The first place to see it clearly is Weimar Germany. Not because it is the only example, but because it is one of the purest. A country does not usually lose trust in money all at once. It loses it in layers, like paint peeling off a wall. Germany's process began during the First World War. The government stopped redeeming banknotes for gold and financed the war by borrowing and money creation. After the war ended in 1918, the pressure grew worse. The government faced debts and reparations. It borrowed more from the Reichsbank, which meant more money entered circulation without an increase in goods. At first, this felt survivable. Then it felt annoying. Then it felt absurd. By 1923, it was daily life. The Bundesbank says the value of the currency fell so fast that in many places wages were paid daily. People carried notes in bags and suitcases and ran to shops to exchange them as quickly as possible. Traders kept lifting prices because every hour of delay meant a loss. Some businesses stopped taking money altogether and wanted payment in food or coal instead. That is the moment money stops being money. When a shopkeeper would rather have potatoes, the spell is broken. The most famous number from that year sounds like fiction. 4.2 marks bought $1 before the war. By November 1923, it took about 4.2 trillion paper marks to buy $1. Trillion. People were not merely poorer, They were trapped inside a measuring system that measured nothing real. A loaf of bread did not cost more because the bread had changed. The ruler was shrinking. Now here's where it gets interesting. Not everyone was hurt in the same way. Salaried workers, pensioners, and savers were hit first and hardest. Their claims were fixed. Prices moved like a wildfire in dry grass. But debtors often saw debts evaporate in real terms. The German state was one of the biggest winners. War debt shrank to 15.4 Pfennig. Imagine an entire mountain of public debt turning into a pebble because the measuring unit vanished. One of the most destructive currency collapses in modern history also functioned as a brutal hidden default. For ordinary people, though, this was not a clever accounting story. It was humiliation and made routine. You got paid and ran. You bargained. You bartered. You watched lifetime savings become wallpaper. Middle-class families who had done the respectable thing were gutted. People with real goods could improvise. The crisis was like acid poured over a photograph. The image stayed, but details dissolved first. In November 1923, Germany introduced the Rentenmark and stopped the printing spiral. Trust in money can be destroyed by policy, but it can also be rebuilt by policy. The fear left by 1923 was so deep that it shaped German thinking about inflation for generations. This brings us to the second part. Sometimes trust breaks where people think they have escaped disaster. If your bank tells you money is safe, but limits how much you take out, do you feel rich? Drop your answer in the comments. The collapse of trust is not only about prices, but access. Argentina in 2001 tied the peso closely to the US dollar. This helped end earlier inflation. Banks looked stronger. For a time, Argentina was treated as a model, but the wall was fragile. By the late 1990s, recession hit. Public debt climbed. Bond yields spiked. Market access dried up. People began to doubt the banks. In December 2001, the government imposed the Corralito. This limited cash withdrawals to 250 pesos per week. Savings that cannot move are not savings. Argentina defaulted on $141 billion. The peso-dollar rate moved from 1 to 3.32. Riots broke out. ATMs were vandalized. Unemployment rose above 20%. The social contract tore. The people most badly hurt were ordinary savers, teachers, shop owners, retirees, families who trusted. In 2019, fear of another Corralito still pushed Argentines to keep savings at home and hold dollars. Now observe what these cases have in common. People reached the same conclusion. Get out. Lebanon shows what this looks like in the age of smartphones. The pound was pegged for decades. Under the polished surface, the structure depended on ever more dollar inflows to fund debt. Reuters described the system as something economists compared to a nationally regulated Ponzi scheme. That means new money was needed to pay old promises. It works until fresh money stops arriving. That stop came slowly, then all at once. Remittances slowed after 2011. Politics remained paralyzed. In 2016, banks began offering remarkable interest rates for new dollar deposits and even more extraordinary rates for Lebanese pound deposits. For savers, this looked like reward. In reality, it was often a distress flare. High returns in a fragile system can be the smile on a cracked mask. By 2019, the flow of dollars was no longer enough. The state needed reform. The elite delayed. The protests of October 2019 were not the original cause, but they were the spark in a room already full of gas. Banks shut their doors. Depositors were locked out of dollar accounts or forced to take Lebanese pounds at deeply discounted rates. Reuters reported in June 2021 that many depositors could access dollar balances only in local currency at 3,900 pounds to the dollar, while the black market rate was around 13,000, meaning a loss of about 70% on value. By early 2024, Reuters reported that some people with certain old money accounts were allowed to withdraw only $150 a month. Think about the cruelty of that. Not no money, just enough to drag out the pain. The macro numbers are even harsher. The World Bank said Lebanon's real GDP contracted 20.3% in 2020 after 6.7% in 2019. Then in January 2022, it said GDP had fallen from about $52 billion in 2019 to a projected $21.8 billion in 2021. This was a 58.1% contraction, the highest contraction in a list of 193 countries. Inflation in 2021 was estimated at 145%, ranking third globally after Venezuela and Sudan. The World Bank called the crisis one of the top 10, possibly top 3, most severe economic collapses since the 1850s, but numbers only show the skeleton. To feel the flesh of the story, come back to Nadim Sroor. Reuters reported that he returned from the Gulf in September 2019 with savings meant to be a nest egg. Then the banking system imploded. Then the Beirut port blast in August 2020 destroyed his parents' apartment, where his family had been living. He said, "Now we are ruined." Maurice Rohr, his father, had rebuilt savings once before after an earlier currency crisis. Now he could access only about $1,000 a month. 75-year-old retiree Samir Sphere told Reuters, "I don't want a loan, I want my money." Joe Nader, trying to repair a damaged apartment building, said his family was selling gold, prayer beads, and paintings to raise dollars. That is what broken money trust looks like in real life. People liquidate memory itself. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. The same mechanism, different countries, different decades, same result. In Germany, the state created too many claims on too little real wealth, and the currency ceased to store value. In Argentina, the state and banks promised convertibility and liquidity they could not maintain once confidence and capital fled. In Lebanon, banks and the state depended on a constant stream of new dollars to honor old promises until the stream dried up. Different plumbing, same leak. At this point, the pattern becomes impossible to ignore. Money is not just a token, it is a public belief system, and belief breaks in highly predictable stages. First, the authorities reassure, then they improvise, then they redefine the rules, then they ask the public to accept that their money is still money, just under new conditions. New exchange rates, new withdrawal limits, new notes with more zeros removed, new labels. Fresh money and old money, insured deposits and uninsured deposits, official rate and street rate. But all of these are really signs of the same thing. The old unit of trust is fractured. There's another pattern hiding here too. Trust does not vanish when people stop using cash. It vanishes when people stop trusting claims. In a modern crisis, you may still see numbers on a screen. Your card may still work. Your bank app may still open. That makes the danger harder to feel. A broken money system today can look less like a bonfire and more like a maze. Ask a Lebanese depositor staring at a dollar balance that can only be withdrawn in devalued pounds. Ask an Argentine saver limited to 250 a week. And once a society crosses that line, behavior changes faster than policy can keep up. People shorten their time horizon. Businesses stop planning years ahead and start planning days ahead. Workers demand pay sooner. Suppliers want cash first. Families hoard. Employers delay. Trust moves from institutions back to objects, back to networks, back to whatever can be seen and touched. It is like a city after a bridge collapse. Official maps still show the road, but nobody who lives there drives that way anymore. This leads to the most painful part of the story. Who pays? Because when trust in money breaks, the losses are not shared evenly. They fall through society like rain through a roof with holes in only certain rooms. The first room to flood is usually the middle class, not the very rich, who often have lawyers, foreign accounts, multiple assets, or political connections, and not always the very poor, who may already have little cash to lose, though they suffer terribly in other ways through hunger and lost services. It is the people in the middle who are hit with special force, because their wealth often exists as claims. Bank deposits, salaries, pensions, insurance policies, savings bonds. A lifetime of caution stored in symbols. Cyprus, in 2013, made this brutally clear. After its oversized banking system cracked under losses tied to Greece and domestic weakness, banks shut their doors for about 10 days to prevent a run. When they reopened, Reuters reported that cash withdrawals were capped at 300 euros per day. Transfers were tightly watched. Later, Reuters reported that 47.5% of deposits above 100,000 euros at Bank of Cyprus were converted into equity, which means large depositors did not simply lose access to part of their money. Part of their deposits was turned into shares in a wounded bank, whether they wanted that trade or not. This is called a bail-in. In plain English, it means the bank rescues itself, using the money of people inside it. Now think about who that hits. Not just millionaires, small businesses, family firms, people who had sold a property, parents holding funds for tuition, anyone above the insurance threshold. A bank account can look like water in a tank. But in a crisis, the law may reveal hidden valves you never knew were there. Greece in 2015 showed a slightly different face of the same fear. After bailout talks broke down, banks shut, and Reuters reported that cash withdrawals were limited to 60 euros a day. 60. Not because Greeks suddenly stopped having money on screens, but because the system could not survive if everyone demanded immediate physical proof at once. Pensioners lined up, tourists worried. Small businesses struggled to pay suppliers abroad. Again, the key point is not only inflation, it is broken convertibility. The feeling that what is yours only under conditions someone else can change overnight. Zimbabwe in 2008 showed the rawest form of monetary disintegration. The Cato study by Steve Henke and Alex Kwok estimated peak monthly inflation at 79.6 billion% in mid-November 2008. Reuters reported official annual inflation at 231 million% before the government stopped giving believable numbers. Prices were revised hourly or faster. Businesses charged in foreign currencies. The central bank kept chopping zeros off the currency, removing 12 at one point in 2009, as if relabeling a broken ruler could make it measure straight again. It could not. By early 2009, Zimbabwe officially adopted hard currencies for transactions, recognizing what people already knew. The local money was finished, but the human cost is even more granular than those headlines suggest. When trust in money breaks, a society stops keeping time in months and starts keeping time in queues. A wage earner thinks about payday, bus fare, and food for the next 48 hours. A pensioner thinks about the next withdrawal limit. A shop owner thinks about whether to sell inventory today or wait one more day and risk replacement costs doubling. Every plan gets shorter. Money, which is supposed to save time, begins stealing it. That is why pensioners appear again and again in these stories. People on fixed incomes feel the poison first. In Weimar, Germany, daily wage payments told workers that the month had become too long a unit of survival. In Greece, a 60 euro ATM limit may sound like a technical measure until you imagine an old man trying to buy medicine, help a grandchild, and keep the lights on with the number chosen in an emergency meeting. In Lebanon, the World Bank warned that inflation acts like a highly regressive tax, which means it falls hardest on those least able to dodge it. Small business owners get cornered too. They often hold cash balances above household levels, but without the political protection of large institutions. In Cyprus, the line between a wealthy depositor and an ordinary business with payroll money in the bank could vanish overnight. In Argentina, a store owner with suppliers to pay and only 250 pesos a week in cash access was like a pilot seeing the runway, but losing the landing gear. In Lebanon, Joe Nader was not speculating on exotic assets. He was trying to repair apartments for tenants and still had to sell personal possessions to find the dollars suppliers demanded. Broken money trust does not stay inside finance. It walks straight into construction sites, pharmacies, and classrooms. Even the poor are hit in a crueler way. In Lebanon, the World Bank said more than half the population was likely below the poverty line in 2021. In Zimbabwe, Reuters reported that over half the population needed food aid. When money fails, public services weaken. The roof leaks everywhere at once. And this is where history gets uncomfortable. The victims were often the people who trusted the system most. Pensioners in Zimbabwe saw savings wiped out. The question is not whether this pattern will repeat. History has already answered that. The record shows those who came through largely shared three characteristics: diversification of claims, moving toward real goods, and maintaining flexibility. Trust in money is like oxygen. The survivors noticed the air changing early. Trust breaks slowly in the structure and quickly in the mind. This was educational analysis. Subscribe and share it with those who need it. I will see you in the next one.